Good morning, everybody. Welcome to Wise Tech for Wise Money, the podcast where we explore the intersection of business, finance, technology, and intelligent growth. I'm Gary Wayne, founder of A1 Solutions International, where we help founders, investors, leadership teams grow more intelligently through better strategy, smarter processes, and practical AI-driven automation. Today's episode is entitled Inside International Investment Banking, Capital, Deals, and the Reality of Mid-Market M&A. Joining me today is Charles Hancock, Chief Executive of Anglo-Suisse Capital, a London-based international investment banking firm focused on capital raising, mergers, acquisitions, and global fundraising. Charles has spent decades in corporate finance and investment banking, with experience spanning firms such as Grenfell, Samuel Montagu, and NatWest Markets, and has been involved in a wide range of transactions across venture capital, private equity, and international corporate finance. What makes today's conversation particularly interesting is that Charles operates in that space between entrepreneurs, investors, and capital markets, where deals are conceived, negotiated, and hopefully completed. Charles, it's great to get you on the show. I've been waiting quite a while to get you here and see you and talk to you. Perhaps you can give us a little bit of a background as to your career, how you got to where you are today. Talk to me about your 10 and 6 investments, and just bring us up to speed.
Thanks, Gary, for that introduction. Couldn't have said it better myself. If we can kind of take it kind of step by step on the career, maybe I'll kind of bring you in as to why I got into investment banking. And it's really one of curiosity, which is the theme I'll come back to later, which was when I was a teenager, walking around the high street, I would see these banks. And I couldn't work out how they could survive on borrowing my 10 and 6 a week. As I got older through university and through business school, I was more and more determined to find out how on earth banks made money. And that led me into investment banking. And I was luckily enough early in my career to get a job with Samuel Montagu. Some of the names that Gary mentioned have now sadly disappeared. We used to call it merchant banking in those days, but investment banking now seems to be the general term. And so I spent good sessions with Samuel Montagu, Grenfell, NatWest Markets, and latterly for the last couple of decades with my own firm, Anglo-Suisse Capital, taking advantage of all the great training and experience and exposure I got from working with those institutions. As I said, I was luckily early in my career got exposed to some big transactions. We did Argyle versus Distillers for Guinness, which those of you with long memories might remember resulted in a big fraud trial with several people going to prison. Hastily, I will add, not on our side, on the other side. But I remember that transaction, which was the largest hostile taker of its time, was the tiny Argyle supermarket chain bidding for the giant spirits company Distillers, which owned all these types of whiskies and vodkas and all these sorts of things. And the culture and the image in the city was that Distillers was badly managed and needed to be taken over. And so part of the early work I did, and I'd like to take credit for it, even though I was a junior member of the team, was to put together a package and a structure to take over a company in a hostile bid many times its size. So I contacted my friends and colleagues on the banking side of the business. I restructured the underwriting regime whereby companies could issue shares, because under the old structure, small companies couldn't take over large companies because the costs would be too great. But I changed all that in the sense of making the downside much smaller and the upside much bigger. Um, we did the first hostile bid for J. Walter Thompson by WPP. JWPP still around, but J. Walter Thompson in my day was the big name in advertising. The consensus at the time was you couldn't do a hostile bid for a service industry because the people would walk out of the doors every night, and if they didn't like you, they wouldn't come back. We changed all that. We did that anyway. And proud to say that was one of my deals, which was the front page of the Times, not necessarily the Financial Times, which is always nice to get a mention there, but actually the real Times, the London Times, we got on the front page there. So I was luckily enough to do some of those early deals. I did the flotation of Eurotunnel, which is still going. Didn't make as much money as I hoped. In fact, I lost a lot of money on it too because I invested in it. But there we go.
How did you learn about structure and how to put these deals together?
Well, in my day, it was very different than today. You just got sent into meetings to sort things out, and no training. It was all on the job. I mean, these days, thank God, the big banks they put you on training courses. You have to take exams. But in my day, you were put on the spot. And I dread to think of the awful rubbish I came out with when I was a junior guy put in charge of meetings. Um, but managed to get through it and live to tell the tale. Um, but it was, in a sense, and maybe coming back now to me now, as opposed to the banking as a whole, is I like to solve complex problems. And so we had this client. In fact, we had this client. And this is great. I had done a deal for them. I'd bought back £250,000 worth of preference shares, which are about as small as deal as you can get, even in those days. Anyway, we got on so well. The next deal was 2.5 billion bid for a hostile bid for Distillers, the largest ever in the UK. So it was doing well on this little complex thing for £250,000 a preference share buyback onto a large hostile deal, which is kind of still the way I approach things: is get on well with the client, work out what they want to do, and then it might seem pretty ridiculous at the beginning, but if you kind of look at it in different ways and structure things differently, then maybe it's possible. Anyway,
What about relationships?
Relationships are difficult. They take a long time to nurture, and it's expensive as time, because if you've got other deals to do, you have to spend time doing it. But unfortunately, they are essential. Now, this is something I want to talk about later, is that relatively early on in the days of Anglo-Suisse Capital, we spent 4 months pitching a multi-billion hostile bid for a FTSE 100 client. And the guys on our team had all done this kind of thing many times before. We knew what to do. Anyway, the client, who's still around and still exists, says, fantastic, I want to go ahead with it. I'll ring JP Morgan. And so we're kind of metaphorically saying, hello, that's what we're here for. He said, no, but JP Morgan are my bankers. And so we didn't get the deal. And I'm thinking, my God, we've got a great relationship. We work really hard. We've sought out the best thing for them to do. And you know what? They never did the deal. The deal was it was in the market for about 2 billion. We could have got it for 2.5, 3. The last time I looked, it was worth 25 billion. It was definitely the target to have acquired. Anyway, the client never did it. And it's down to relationships. So I was a bit, shall we say, disheartened then, because I guess it was relatively early in the days of boutiques. I mean, boutiques have always been around, but now they're much more acceptable than they were 10, 20, 30 years ago. So we had a kind of, I think in the hedge fund world, they call it a style drift. Even though raising capital was part of our toolkit, along with M&A, etc., and IPOs, we shifted to capital raising. And the reason is you need a much less deep relationship to get a capital raising mandate than you do an M&A mandate. The reason is the client wants the money. And as long as you're bearable and don't smell too much and look vaguely presentable, then you can get the mandate. But for an M&A deal, an M&A is very complicated. It's public. There's lots of rules and regulations. There's cash involved. You need someone you can really trust, and that only really comes after a couple of years of close working together. But what we found is by developing the relationship by the capital raising entry, we then get the good relationship for doing the M&A afterwards. I don't know if that makes sense. So
Sure.
we lead on the marketing for capital raising, but we do get the M&A work because we build up the strong relationships once they see what we can do.
Once you've given them the money, obviously they feel comfortable with you. You've proven yourself, and now they obviously are happy to move on to the next leg.
Exactly. Yeah.
You've worked through several market cycles. What were some of the defining experiences that shaped how you approach deals today?
Well, yes, I've been through a couple of crashes, which is interesting. And there used to be this thing in the early days, and it still exists today, called the window, the market window to do an IPO or to do a deal or whatever it is. And when I was young, I didn't understand it. I thought the markets are the markets. You do whatever it is. But as you get older, you see that some things, I hate to say it, come in and out of fashion. And a few years ago, we had the SPAC fashion, which was special purpose acquisition vehicles, where people would put together something with 10 or 100 million, float it on the stock exchange, and then try and do a deal 5 to 20 times bigger. Now, the whole logic behind a SPAC is ostensibly to avoid some of the regulations involved with doing a flotation. But the way the world is, you still have to do all that work for a SPAC as you do for an IPO, a flotation. So it's actually driven by illogicality. For some reason, people think it's mad. Anyway, when I last looked, the SPAC cycle was 5 years ago now, 4 or 5 years ago. When I last looked, I think the average price of a SPAC was something like 1% of what it was issued at. It was phenomenally bad. And hundreds of billions of money went into this and was basically all lost. So yes, you talk about cycles. After the global financial crisis, 2007, people didn't know what to do. They're very nervous. So the government pumps money into things to keep the stock markets going, to keep liquidity. And so there's a lot of work doing cash deals during that time. Now, what you've also had growing up over those period is regulation. Okay. Now, it's good. People's clean, greater transparency, fewer scams, etc. Or I hope so. But in fact, what that has led to, and not many people realize. By the way, I'm including in that, environmental stuff and green stuff, ESG as a whole. What that's actually led to has been the growth of the private markets. And so basically people don't want all these board reports and all these extra things. So what they do is they stay private. What you've got, this massive market of venture capital and private equity world, which in the old days, they'd buy a company or a stake and hopefully it would float within 5 years. And then you could show your investors that you made a lot of money for them. And can you give me some more and I'll make you some more money. But what we've got, because fewer and fewer people are floating on the stock exchange, you have got private markets where people stay. And so I don't know the exact stats, but the average time now of a private company before it goes to market is now 10 years rather than 5 years. So what that means is, first of all, companies want to grow because there's a market, they can now grow without being floated on the stock exchange. Okay, that's a major shift in psychology. So in the old days, everybody thought they'd grow a company and float on the stock exchange. Now they think, I can grow a company, I can still get cash and not be listed and have the scrutiny and the global regulation and all those other things. So I don't know if kind of regulators realised that they are responsible for the growth of the private markets, not necessarily anything else.
What
But the
is
growth,
it simply down to regulation? People don't want to go
yeah, I
public
think so.
anymore.
Yeah, I mean, fundamentally, yes. I mean, you've got all these, great tech companies, primarily American, Sequoia, etc., who are massive. And they're asset class in their own right. But what they have done is they've excluded the public and general masses from taking advantage of some of these tech bubbles. I mean, yes, people think like Uber, etc. They're now on the stock exchange, and the public can participate. Um, but if you take AI, and it is changing, but AI, for example, you know, it was actually very difficult for your ordinary investor to take advantage of the AI bubble because a lot of the companies were private. But it also explains why AI-related companies like Nvidia got into its place as the largest company in the world was because there weren't other AI companies to invest in. They can't invest in OpenAI. They can't invest in Anthropic. They can't invest in Elon Musk's SpaceX. They can't do that. And so what it means is that those bits of AI companies that are on the stock market, like Nvidia, like Google, like Microsoft, they get overinflated. I mean, when's a bubble not a bubble? Because there's been relatively few companies to invest. I mean, there are lots of companies out there, but smaller than the industry.
What about pre-IPO? I mean, I see SpaceX being offered pre-IPO, some of the other American companies being offered. Is that a huge market?
Yeah, well, I mean, pre-IPO is still the private market, and it used to be, the phrase to get people convinced that they'll be able to cash out in the relatively near term by saying that there's an exit due on the horizon. Now, interestingly, the term pre-IPO has kind of fallen out of fashion. I mean, I'll come back to SpaceX and things like that, what they're talking about now, because people are getting used to holding on to these private assets for some time. Now, talking about the recent SpaceX deals and the OpenAI deals, they're being labeled pre-IPO is because they are coming to the market. How quickly, how slowly, it's kind of due to the markets up and down. But so they are now putting the label on these pre-IPO issues in a sense to make it more attractive. But is it more attractive? OpenAI just over a year and a quarter ago was going at 180 billion. Okay, and it was a lot of yes, maybe it seems a bit pricey, etc. Then less than a year later, it's coming out at 350 billion valuation, and you're thinking, oh, I should have put all I could into it at 180. Now the IPO is valued is being touted as being valued at half a trillion. I mean, it's amazing for a company that, in theory, was not for profit. I know there's technicalities about how it's changed, and its core product, which is large language models, has become ubiquitous and cheap. Yet it's got a touted value today of a half a trillion. That is phenomenal, phenomenal. Now, what it doesn't mean, it doesn't mean it's not worth it because you've got Google AI Google was, or Alphabet was valued at 3 trillion. But Google has got all these customers and a number of other revenue streams, Google Cloud, Google Ads, etc., all these other things, Google Search, that can make 3 trillion. But is really OpenAI worth half a trillion? Well, maybe yes, maybe no. You can't tell. OpenAI is getting a lot of data on people, and the key is data. And it's getting more data on people than even Google, and Google knows more about you than you do yourself. But there you go.
Just moving back to Anglo-Suisse Capital.
Yeah.
What made you set it up?
Well, it's an interesting one actually. It's a combination of two factors. Is I was offered a job and accepted, and I actually got paid the signing on bonus for a large European bank to head up their M&A, their corporate finance arm. As was usual those days, I had to go on 3 months gardening leave, which I had nice 3 months in the Caribbean. Um, but sadly, during that time, the guy who hired me died, and his replacement. I mean, the guy was one of the biggest well-known leaders in European corporate finance, but his replacement didn't want me. So we came to terms. I got a payoff. At the time, it seemed great, but in retrospect, it's quite tiny. But that's life. And so I was a free agent, and I went to a client who'd been asking me for years, why don't we set up a bank together? Remember, this was 20 odd years ago, and the idea of boutiques, and we called it a bank. It probably meant an investment banking firm, which we've got now. So I set up plans for an investment banking firm, what to do, and he was saying, "Can you make it cheaper? Can you make it cheaper?" And it got a bit ridiculous in the end. So I just carried it. I started working for him on all his projects, um, and then found one or two other clients. And so therefore, for the first 10 years, I was working for basically 3 clients, doing lots of deals for them. But if you're interested in the name, which was a lot of people asked me about, is that one of these clients said, have you thought about your name, Charles? I said, Charles Hancock and Co. What's wrong with that? He said, well, if you're Charles Hancock working for Charles Hancock and Co., you sound like a one-man band. So he said, it's no bother to us. We like working with you, but have you thought about something else? So, the client was based in Geneva. I thought of the most boring name I could think of, Anglo-Suisse Capital, and I took on the name, and it was good. And we've carried on since. I used to say it's a bit like Credit Suisse, but smarter. But nowadays, that joke,
And talking about that,
that
what
joke
is
turned out to be
the
right. Sorry, Gary.
talking about Credit Suisse and people like that? What is the advantage of using a boutique advisory firm like yours over and above these so-called big banks?
Yeah, well, it's a very important question, and what we come to all the time. It used to be, it's changed now, that changed, but it used to be, once you get to 100 million, use a big investment bank. That's changed now. We have one, two, three, four, we're probably about 5 or 6 deals over 100 million we're working on now. So that's changed. But there are some advantages. First of all, we like to think we're quicker and more nimble. And I think that's a fair point. They take a long time to do onboarding. We do the same onboarding, but we develop systems to do it. Also, um, big banks, when they try and raise capital, go to their existing client base. We don't. We go to everyone. We have a very large database which we've built ourselves. We update 200 times a day on various things, who's interested in what they like, what they're interested in, what they're not doing, what the project is. So we have a tech advantage. Now a lot of the big banks have embraced tech, like JP Morgan, Morgan Stanley. Um, but I think they've kind of done it more on the kind of processing of millions of transaction size and various other things. So I don't knock them because they're good. But what we have got, and it brings me back to something else you mentioned, is what drove me into investment banking, and it's really is there's a problem. Business needs capital, people want to invest, and it's complicated how you connect the two. And so part of our philosophy at Anglo-Suisse Capital is always driven by that fundamental issue: how you get capital to people from people who want to invest it to people who want to use it. And so what we have got, and we're assisted massively by AI on building up the systems, not just using AI on systems, like, for example, doing due diligence reports, of which we probably do 20 a day, which in the old days would have cost you 10 grand each. but in building systems to update our database, to work out who is the ideal investors on a particular transaction, to working out what gaps there are in presentations, to analyze, the story we should give. I mean, at any particular time, great embraces of the AI bubble. And as part of our philosophy is we're quite small. We could get wiped out by a lot of these other tech disruptors. So the way to survive is to try and keep ahead of the wave. And so that's part of our philosophy, keep ahead of the wave.
Where does real deal flow come from? How do you actually find deals and get deals?
Well, as a matter of fact, we find we're quite lucky in that respect because I do speak to competitors, and they are always saying, "Where do you get it from?" We get a lot of our business comes through the door, a lot of it from existing clients, but we have I guess in retail terms, unsophisticated, but investment banking terms, quite sophisticated way of reaching out to people. If we think someone might be interested in something, we reach out to them. We don't reach out in a heavy way. We reach out in are you interested in um, a defense company building drones or whatever. And they'll say, no, thanks, no, we're not Charles, but by the way, can you help us on this? We go to a number of conferences, and in fact, we reach out to people to say, we're going to be at this conference. Do you want to meet up and talk about what you want to do? And there's one particular one that we're quite close to, which you may have heard of, Slush, which is a tech conference in Helsinki every November. Um, we're quite close to people on a kind of side conference called Knights of Nordics, whereby we invite a lot of our investor contacts, and they go and attend there. And at first, I was always, well, we're introducing, they're going to be fine, lots of companies to invest, we're going to lose out. But actually, no, it's not that. It's actually they then trust us to bring us deals and give us work. So we get business from all sorts of things. And frankly, we're also using AI to find out other methods of reaching out to people, on social media and various other things, which kind of all brings into the whole of where you do it. B2B business marketing is quite difficult, but there are lessons to learn from B2C marketing. I don't know, 50 years ago, tech was driven by defense. And then for some reason, it went consumer, and you have mobile telephones. And consumers developed tech. You've got Google and Uber and all these other things. And now tech is gradually making headways into B2B. Fortunately, not as much as devastating some areas, but it will come. But I'm hoping to be ahead of that wave.
What typically causes deals to fall apart?
Aha, a lot of that. And yes, it's something I learnt, I guess, again, mid-career, something called expectation management, which sounded a bit sophisticated when I heard about it. A deal's a deal, let's get it done. And then you realize what deals come down to is what people are wanting and what they expect. And so I am forever trying to make both clients and investors more realistic. And it's not only good for getting the deal done, it's also good for your reputation because it means you're not bullshitting too much. But once people realize expectations match, then deals get done. So I have come across many deals where people are expecting, particularly founders, they're expecting to sell their business or part of their business for a large amount, and people come in with low bids. Um, it's you've got to manage expectations, and that's part of our job. Part of our job. The other one is, and I hate to say it, there's some bullshit out there, and uh, people kind of gloss over things. They're building businesses, they're looking to the future. They're not realizing that some of the stuff they've got doesn't necessarily it does exist or as robust as they think, and so under due diligence, it comes apart. Now, it's a big difference in the private markets and the public markets, because in the public markets, by the publication of the prospectus, and having the lawyers go over everything, everything's been seen and noted. And the private markets, you haven't got that. So in the private markets, there's a much heavier emphasis on due diligence. And due diligence takes time and money. And so, in a sense, due diligence comes at the end of a transaction, whereas on a public market, it's taken for granted from the get-go. So that's the big major difference between public and private markets.
You mentioned you do a lot of capital raising. Tell me how hard is that to raise capital?
Capital raising, as I always say on my first meeting with a prospective client, is much difficult than you think. I mean, can I give you an example, which is kind of slightly out of date, but it illustrates the point. It used to be, and in the old days, a lot of private market work was in hedge funds and private equity funds, and it used to be the norm that it takes a year to raise capital. Okay. Now, what you're not seeing there is that's only the amount of time for the people who actually raise capital. What about those people who don't raise capital? The time's infinity. So it used to be a year. I think that time now is down to about 6 to 9 months, whatever it is, in general. I like to put ourselves at kind of, let's say, 4 to 7 months, because we're a lot quicker. I mean, everything takes forever in the private world. I mean, the public world, it's great. You can get a deal done in a few days. It's actually more than a few days because you've got preparation. But you can do that and you get the cash in the bank. But in the private world, it isn't. People aren't in a rush. Now, interestingly, the unicorn capital raises like OpenAI and SpaceX, they're shifting the momentum because they expect the capital to be raised in a number of days, a small number of weeks. They're also getting there's no due diligence. I mean, the accounts of OpenAI and SpaceX, I mean, there's bibs and bobs around, but there's not full due diligence there. So people are having to make their bets on public information, which is a completely different mindset than, raising 10 or 20 or 30 million for another private company. But what it's doing is it's driving the mentality because private equity funds are used to taking a number of months to review things, to get their due diligence experts in, to get their negotiation time in. Now, one of my missions is really to shorten that time frame because people can't rely on possibly raising money at a possible certain price in 6 months' time. Their plans are months ahead rather than years ahead. And so part of our kind of ethos is to try and get things done as quickly as possible. I kid you not, and there's one going at the moment. I've seen deals fall apart on NDAs, on confidentiality agreements, which should be a kind of no-brainer prerequisite. But sometimes people insist on that. Some people insist on that. It takes forever. They've got to get their lawyers involved. These are the challenges I have every day to get things smooth and done as quickly as possible.
What do entrepreneurs most misunderstand about capital raising?
Well,
And also, who are the main parties nowadays? Is it family offices and hedge funds, or as opposed to institutions? How does it actually work?
Well, for entrepreneurs raising capital, there is a structure these days which is relatively formalized, driven by the US, to go from founder to fully fledged quoted company. Of course, Series A, Series B, Series C, seed capital, the initial one. We're not in the seed market. We're in the bottom seed market, the Series A, Series B. So you can talk about these things, and people know what you mean. Now, one of the numerous definitions of various parts, but one of them is that Series A is when you get your first institutional investor involved. And maybe I should say professional investor rather than institutional investor. And that means someone who gets involved, who invests as a living, as opposed to someone who's got some money and is backing their son, their mate, their colleague, someone who's telling them a good story in the pub, etc. Now, entrepreneurs, by their very nature, are forward-looking, optimistic people. If they weren't optimistic, they wouldn't be running a business, right? Or trying to run a business. So they will have got their vision, and they'll have sold that vision to investors. Maybe it's their family, their friends, their other contacts. And so their mentality of raising money is telling a good story. It's not necessarily a bad story, but that's how they raise money and how they think money is being raised because it's worked for them so far. When you move to Series A, it's different. You've got institutional capital, right? And it doesn't look to the future and the millions you can make. It looks to where can things go wrong and where can I lose money? And that's a big culture shift for entrepreneurs. They're going from being surrounded by people who believe in their vision, people who talk the same language, to a whole bunch of people. Sorry, let me get rid of this.
Sure.
To a whole bunch of people who are there to minimize risk and to only invest in clear facts and what's being done. So that is a toughie for entrepreneurs because they're dealing with people who don't think the same way. Part of our job is to kind of manage expectations in this sector, saying you're going to become a people who aren't going to be interested in the 17 different countries you can expand to and the other markets you can dominate. They're interested in how secure is your IP, what's actually your run rate last month, all these facts, which is kind of anti the culture of an entrepreneur. I mean, yeah, of course, some of them are smart and they get over it, and lots of companies do get over it, but it is a barrier between going from seed to Series A. So I don't know if that answers your question. Yeah.
From my experience, and I talk to a lot of people, the biggest issue I hear is raising seed capital. Obviously when people start out, funds are very important. They don't always have enough of their own. And getting that initial seed capital is quite difficult. Is that something you deal with or come across?
Oh, yeah. It's absolutely the biggest issue. Now, to kind of put it into the bigger picture, at every stage of the cycle, whether it's seed, whether it's Series A, Series B, pre-IPO, IPO, or even raising capital when you're quoted, there's a market. There are investors. They're different amounts, sizes, different constraints, mandates, etc. But there are investors. The problem is when you're at seed, there's not a lot of, shall we say, institutional investors willing to throw money at you. And interestingly, it's where the government steps in a lot and offers grants. Now, I can have my whinge and rant about how difficult it is to get those grants, but at least it's there, and there's a willingness of government to help. But it is difficult. Not everyone has a rich family. Not everyone has rich friends. Also, what doesn't happen is that a lot of entrepreneurs or would-be entrepreneurs don't necessarily understand the realities of business. A lot of people think having a good idea is the route to riches. In a way, it's almost a detriment. What you want to take is a proven idea and build that where no one else has succeeded. Sorry, I hate to dampen people, but yeah, having a good idea is not, it's not the crock of gold at the end of the rainbow. It's actually the mere spark of an idea that might set you onto the path of a business. So yes, ready to seize capital is difficult, and I get an awful lot of people asking, can they raise seed capital for me? Can they do this? And the answer is, well, we probably know a few people, but that's not our business. I mean, we at Anglo-Suisse Capital charge a retainer. We have to. If we just charged if we just charged the success commission, then we'd get everyone telling us how wonderful everything is, everyone hiding all the bad points, which we don't find out until 3 or 4 months later when the edge of a deal and we found out they don't own the tech, that they lied about something else, that the market isn't what they said it was, or whatever it is, this kind. So we at Anglo-Suisse Capital do charge a retainer, but it's necessary to get our attention and to confirm that the entrepreneur is so committed to the idea He's done all his research and he believes in it that it's capable of raising the capital.
Okay, that's excellent. Now moving on a little bit, obviously you do a lot of cross-border transactions. How have you found cross-border since Brexit, etc., and how difficult are cross-border transactions generally nowadays?
Well, first of all, I'd like to say I love cross-border transactions. It's what gets me going. It's the complication involved by transactions, cultures, loads of other things. It's not just a cross-border transaction; they're rare, but they're there's always some issue. Now, in relation to Brexit, yeah, I mean Brexit has increased the regulatory barrier. EU has not reciprocated in the freedoms allowed in the UK, which is a cost which we have to bear when we get through, but we do it. But interestingly, one of the big deals we're working on at the moment is that an Oriental company wants to get into the EU or expand globally, and it's finding that if it can acquire an EU-based company, it gives it across the whole market. So that's kind of good from that perspective. But generally, there's always business globally, and we think of ourselves, we describe ourselves as global investment bankers. So whatever country you're interested in, whatever country you're based in, whatever country you want to expand into, we can help. That's what we do, and we're never going to know all the pitfalls, but we're going to know a lot of them, and we won't necessarily be too perturbed when we come across them.
Is there any area globally where you're seeing more appetite for capital and more appetite for actually funding and lending money or investing capital?
Years ago, we used to focus on commodities, mining, oil and gas. I've got a good background in that. But we found it difficult and hard. I remember one investor saying to me, "Charles, stop sending me these great investments. I've got too much blood on the carpet to be able to invest in another thing." And that was a turning point for me. And I just thought, we can't be stuck in industries which are not good for what we do. So then we expanded. And let's be clear, I've done deals in many industries to start off with. So expanding our business to becoming global was not that difficult for me. But in terms of where the capital is, first of all, and let's focus on the private side, although there's similarities in the public side as well, is that there was a lot of appetite around the SPAC period, and then it kind of died off a bit. In a way, the whole private market is driven by what goes public because people see exits. But as I talked about earlier, that's kind of not as clear cut as it used to be. But the over the last few years, let's say 3 or 4, the private capital being raised is not significantly increased. I mean, depending how you measure it, and there's lots of different measurements and statistics on this, it's actually stayed roughly the same. It's picking up a bit this year, but the vast majority of that capital is in AI and technology. Okay, that's kind of obvious, but in a sense, it's a chicken and egg situation. Now, but what is a feature of the recent couple of years investment is that investment has come from corporates, from Microsoft, from Amazon, from Nvidia, which has skewed the statistics. It's not other conventional, institutional, non-strategic investors. It's been corporates. So that skewed the statistics, and the overwhelming proportion of that is in AI. So that skewed them. So you've got, I mean, let's say 8 to 10 years ago, 6 years ago, fintech was the sector. It's come down a lot because it's shifted more to AI generally than fintech specifically. So we find a lot of our work has that kind of element somewhere. There's still the ESG area, which is good, and there's a lot of investigators dedicated to that. They have it as part of their mandate, so that's still good for us. And the other area that good is property real estate, and that seems to be quite steady. There's always a market for that. The returns are not stratospheric. They're not 10 times your money or doubling your money in a year like OpenAI, but they are steady. So I would say the areas where there's both appetite and requirement for capital are AI, broader tech, ESG, and property.
Cool. So you spoke a lot about AI and technology. Just before we wrap up, tell me what you think about the future of technology is in the investment banking world or boutique banking world. I mean, where do you see it in the next 3 to 5 years? And I know that technology is moving so fast, it's hard to keep up from one day to the next. But what is your vision?
A few years ago, let's say 7 or 8 years ago, a lot of our clients used to be tech companies. And I was quite pleased to get the mandates, had to learn about tech. And then I had this thought, we are so lucky in finance that we are protected from technology. And then I listened to myself and I thought, what a load of rubbish. We're as vulnerable as any industry. And then I analyzed it. We were partially protected in finance by two things. Regulation, which is difficult, and also complexity. But what you've got, and has led to the rise of fintech and also a consequence of AI, is that both regulation and technology have been addressed. RegTech is a term now, and complexity is dealing with AI is dealing with complexity in a way that's never been seen before. So, as I said to myself, the barbarians are at the gate. What are we going to do? We are vulnerable. I thought, do I go to another industry? Have I got time? Am I old enough or young enough? I thought, no, the only way is you're stuck. Get ahead of the wave, which is something I mentioned earlier. So embrace the technology. And embrace the technology in terms of general technology as was 6 or 7 years ago, and AI as it is today. And so what I'm finding is that it helps us. We can compete with the larger banks. Again, as I mentioned earlier, because we're nimble, because we have a focus on being quick. The larger banks are more process driven, they're more stable. Each person is more specialized. We're kind of have to be more flexible because we have to be. We have to do more jobs than do particular, just onboarding or just list columns and just website maintenance, etc. We're familiar with all those things.
If you could change one thing just before we go about the finance industry, your day-to-day job or career, what would it be? What would you change to make the marketplace that you're in more efficient?
For the marketplace we're in, the kind of elephant in the room is regulation. And quite often, I mean, you particularly said in the EU, they bring out regulation in order, ostensibly, to make things easier. In fact, they make things more difficult. And I see it time after time. Now, as a matter of fact, I'm kind of cynically half not that bothered because we can adopt to that new regulation. That's what we do. But it's bad for the industry, companies, investors, and the economy as a whole if it's more difficult to raise capital for those companies that need it. And so what I would like to see is more efficient regulation. That doesn't mean removing regulation. It means making it more, moving down barriers to regulation.
Excellent. All right, Charles. Well, I think it's been a really good podcast. I mean, I've learned a lot
Thank
myself, and I've been in the industry a long time, not sat on your seat, but I've delved in many of the things you talk about. Where can people get hold of you? Where can they learn more about your company and your services should they wish to?
Well, our website is anglo-suisse.com. Anglo-Suisse.com is an old company which has been sold, and I missed out on getting the website there. But there's a contact form there. It's a very simple contact form. I decided years ago that any contact form with more than 3 questions was too complicated. Please contact us there. We're in the market, capital raising, M&A. We are global. We like complex deals, and we are fast. Probably say relatively fast, not a week, but faster than the competition.
That's fantastic. Well, thanks for attending. I'd like to say to the listeners, thank you for listening in. You know where to find Charles. If you enjoyed the episode, listen out for the next one. We'll be back with another episode of Wise Tech for Wise Money in the next week. Thank you very much, Charles. I'll talk to you in a second. Thank you once again, everybody, for listening in.